Welcome to the About podcast. Here we explore your financial health in simple and easy to understand ways.
All right, well, welcome back to the About podcast. My name is Jeremy Scott, one of your hosts, and joined as ably as always by my co-host, Roy Hookey. Roy, how you doing today?
I am awesome.
I hear we are talking about my least favorite thing. Kind of, sort of.
Well, I would potentially say that's probably very accurate.
Yeah, and we've talked about death and taxes so far.
This is worse than that.
But we are going to talk about politics. It is that time of year. I mean, also that time in our life of our country with major national elections happening. But not just politics, but politics and the economy. From, as we were talking before we started recording here, from an evidence-based approach. And once you said that, I had a little more calmness in me.
I can feel your blood boiling.
Yeah. Well, in my world, it's, I already deal with one of the most contentious things that people have strong feelings about, which of course is religion. As a pastor, I'm already occupying one of those don't talk about it at the dinner table kind of spaces. And so I've actually striven to stay out of politics. I mean, you've been around the church long enough. I've been here for a number of years now. We've been through national elections before. How everybody's kind of figured out it's not something that I'm going to dive deeply into, because that's a personal conviction, personal conversation that people have with themselves about their values and how they want to express them and how they vote, other than encouraging people to participate in our democracy, which I think is great and wonderful. And we live in one of the best countries in the world, and democracy is one of the reasons we live in one of the best countries in the world. So I'm pro all of that. But as far as like partisanship is something that I definitely try to avoid.
Well, let's just start here.
So,
what's your title at the church?
I am the pastor and self-appointed chief joy officer.
Okay, I want you to use that title today.
Okay,
in this conversation.
I'll bring some joy
to it. So, politics and investing. I've been getting a lot of questions from clients about, hey, the election's coming up. What do I do? Do we need to do anything different?
Right.
That's really the catalyst for this conversation today. And, I am Switzerland when it comes to politics, and my clients, they can make decisions they feel are best for them and how they vote. And we're not talking about any of that stuff. We're just talking about the potential fear that is created, the uncertainty that is created by something that the media really hypes up and plays into, right? And there's actually a quote that I have today. This is from Peter Malik, the CEO of Creative Planning, but he actually said, the media has a fiduciary responsibility, but it's not to you. So, we have to remember that when it comes to an election year, that, there's a lot of fear that's being sold because it sells.
Right. I sometimes wonder, you look at those other countries where, they do national elections, but they do it when they want to, or when they get called, like, oh, we're calling a national election. I'm like, so nobody knows necessarily when it's coming.
That would be
like,
better.
Man, I wonder sometimes, because it doesn't matter what your politics are or where you fall, on any of the between the parties or anything like that. The one thing is unescapable is it creates this time of uncertainty, because we're not sure who the most powerful person in the world is going to be. We have strong opinions about most people have strong opinions of who they want it to be. You add into that, things like who controls the House and the Senate has become so much more. I mean, that's always been kind of a thing, but it feels like that's even so much more now. Like every single race is like life and death. And we got a 24-hour news cycle and Facebooks and socials and all that are more than happy to tell us constantly, why the world will end if this thing happens versus this thing happens.
Yeah, and now we have independent media to add into the mainstream media, and you're getting hit from all angles.
Every random guy with a podcast talking about stuff,
A couple of schleps right now.
Yeah, I know.
About it.
So the uncertainty is unavoidable.
Absolutely, and one of my favorite movies is Batman.
Oh,
but
like the original Tim Burton Batman?
No, actually, I really like the Christopher Nolan Batman.
Oh, the original Christopher Nolan Batman. Yeah, I'm down.
Yeah. So, Christian Bale, right? Heath Ledger was probably the ultimate Joker of all time.
All time.
But, he had a really good quote, too, that when he was talking about movie making, he was saying that dystopias sell twice as well as utopias at the box office. Right, so if you watch that Batman, it's a much less cartoony and much more serious and dark, and that just sells better.
Yeah.
So we just have to remember that as the consumer, because we're the consumer,
Right.
that's what's being sold to us because it engages eyeballs, right?
Right.
You have a war on television nowadays.
Right.
Who's watching that 24/7?
Right. Well, there's always a conversation today, like around Facebook, like where you realize with Facebook, you are the product. Your attention is what's being sold, but it's not being sold to you. It's being sold to advertisers. And on one hand, I think that's true. On the other hand, it's not really any different than cable television or anybody else has been for years. We've been the product for a long time.
Yep.
And our attention is the product being sold.
Yep.
So, yeah.
So in my world.
In your world.
So with the investments.
Right.
There's a concept of, I do better when there's a Democrat in the presidency, or I do better when there's a Republican in the presidency. And right now I'm actually looking at an article. I just want to throw out the actual, it's a investment insight by Morningstar Wealth. The title of it's Oil and Water, an Evidence-Based Approach to Politics and Investing, which evidence-based is something that my company, Credentialed Wealth Advisors, is huge about for our investing. This is right up my alley. I loved it. And
Morningstar is a reputable.
Yeah.
I mean,
this is the math, folks.
Yeah.
Now, you may or may not like the first piece of what I have to say here, but we're looking back 70 years here.
70 years.
70 years. So back to 1953 from 2023.
Right. But that's really kind of back to the birth of the modern economy. I mean, back to that post-World War II switch to, we got people going to college. We've got that kind of the birth of the modern mixed economy where you've got knowledge workers and you've got industrial workers and you've got all that kind of stuff. So that seems fair.
So if you invested $1,000 back in 1953 when a Democrat was president and sold out when a Republican became president, right? That's the last 70 years. You were in and out of the market based off of who was in the White House, what party was in the White House. Okay.
So I bought when the Democrat was sworn in, and I sold when the Republican came in, and then I just kept doing that.
Right. If you just kept doing that for the last 70 years.
Started with $1,000.
$1,000. It'd be worth $61,800 today.
Okay.
Seems like a lot.
61%, 60 times return, 61 times return, but in 70 years. I mean,
Sounds like a lot from $1,000, right?
Yeah. It sounds like the market.
Well, okay. So let's do the opposite and say we're going to only buy when there's a Republican in, and sell when a Democrat goes in.
Same $1,000.
Same $1,000. It's actually worth $27,400.
Huh.
So you would think to yourself, well, geez, I should definitely invest when there's a Democrat and sell when there's a Republican.
Sure.
I don't think you can really look at it like that because you always have a lag effect from presidency to presidency, right?
Right.
Policies take time to implement. So, we have
everybody blames the last guy.
Yeah, exactly. And we have some mistakes. So if you just said, okay, I don't care who's president. And by the way, I should be clear. I didn't say this. It's investing in the S&P 500.
S&P 500.
Yeah,
okay.
sorry.
Yeah. That's a good point. What are we investing in? Are we investing in like Sears? That's been a ride.
S&P 500. Okay, so we put in that same $1,000. We don't care who's the president. We just let it ride.
Right.
Let it ride. Let me ask you. We had 61,000. We had 27,000. If we just let it ride, what do you think the return would be?
I'm going to go somewhere like in the 40s. 40,000?
40,000?
Yeah.
1.69 million.
Oh, geez. So basically the thing is just stay in.
Stay in. A president will not.
Is that a real number?
That is a real number. You can actually look this article up. That's why I gave the title of it. 1.7 million by staying invested.
Versus 61,000. Yeah.
Yep.
Whew.
Yep. So it goes up and down per president. I actually have a chart here you can kind of see too. I know our listeners and our YouTubers can't actually see what I'm showing them, but it just shows per presidency, the market trends what direction?
Up.
Well,
we talk about that, right? I mean, there's a historical trend in which the market returns about X amount percentage, over a long enough time frame. That's what it does. And every time we're in a downward slope, we remind ourselves of that as a way to not freak out. And every time we're in an upward slope, we remind ourselves of that so we don't assume the good times are going to last forever.
Yep.
That it all kind of just average. There's a progression.
There is a progression. And staying invested based off of your plan is everything.
Mm-hmm. Whatever
your plan is, everyone's different. And this is the big thing that I ask people if they come to me like, well, what should we do, Roy? Because the election's coming up. I was like, has your plan changed? Has anything in your life changed that fundamentally would adjust our plan? Well, no, I'm just worried. Like, well, statistically speaking, we need to just stay the course based off of our current goals if they haven't changed.
Right.
Because I know from history that that's been a good, decent outcome. Now, that history is not always the future, right?
Right.
The past does not predict the future, right? But we just have that to go off of to make our decisions.
Right.
So,
well, yeah, and I think if you think about it, kind of take a second step back and think about it even logically. I mean, yes, absolutely, the president of the United States has a lot of power and authority, both real and symbolic, and can do things that cause probably things that effects that show up in the market, fluctuations. But at the end of the day, I mean, the market is huge. It's based on tons of factors, trillions and trillions of dollars, hundreds of millions of people, being involved in it. I mean, I don't want to downplay it, but on one hand, I'm like, well, I mean, of course, if you look at the things that really do have done harm to the market, you look at the Great Recession or the Great Depression, all kind of stuff. The seeds of that were over multiple administrations. I mean, and there's no one thing you can point to. There's no one president's fault or even one party's fault. About it. It's usually a succession of things that cause the giant market issues we all look at and go, oh, I don't want to go through that again. I don't want to go through the recession again. I want to go through the Great Depression again. Or it's things like COVID. I'm like, well, COVID didn't care who the president was.
No.
Right? It's a virus. It doesn't care. And so I think we like to sometimes even exaggerate in our mind how important some of these things really are if our perspective is long term.
Exactly.
If I'm a day trader, maybe I have a different perspective on it.
Well, even a day trader, this is a great example to show for that, is that people think they can kind of get smart. Like, oh, I knew this was going to happen. Well, you're saying that to me after the fact. You didn't know really beforehand. But
hindsight.
One example is when President Biden came into office, there was one concern around energy. And people thought energy was going to do really bad under a Biden presidency. Do you know what the number one sector is during the Biden presidency?
For growth?
For growth.
I'm going to guess you're going to say energy.
You got that.
Yeah.
So if you're thinking, oh, energy's bad and I need to sell out of energy because, Biden's going to hurt energy, the opposite actually happened.
Right.
Another example is when President Trump was in office, he did some tariffs on China.
Yeah.
So the big concern was, oh, that's going to be really bad for Apple, because Apple gets a lot of their stuff made in China for their iPhones.
Oh.
Right? So there was this big concern that was going to have this huge impact to Apple, and they were going to go down in value because of it. Do you know what Apple's return was post that tariff going into place?
I seem to recall Apple seems to be doing okay.
They were up 8 times.
Yeah.
8 times what they thought they'd be up.
Right.
That's nuts.
Well, and you think even too about all the doomsaying about COVID, and this is going to be the end of this industry, end of that industry, and all kind of stuff. And it wasn't like there was some bad times in there, but then, the automobile industry roaring back, I mean, and, all these things that you're like, oh my gosh, this is the end of the world. You're like, well, maybe not.
That's exactly the case. So people who think they're going to get smart and, I'm just going to sector rotate, or I'm going to tilt my portfolio into this bucket versus that bucket, that can be just as harmful as selling out of the market.
Right.
So just stay diversified, because nobody knows, unless you're in Congress, what's going to happen.
Right.
They seem to do a really good job at insider trading.
Well, what? No.
Yeah. So I just wanted to share that real quick, because that's really a big part. And again, that article, people can read this if they'd like to. It's quite good. I really liked how they approached it, because it's not politically motivated. It's just numbers.
Yeah. I mean,
it's the from Morningstar Wealth, Oil and Water, an evidence-based approach to politics and investing. If you'd like to search up that article. Yeah. You were going to say something. Sorry.
Yeah. Well, I mean, I think I've seen different charts like that around different things. Like, which party does the deficit grow under? And it's just all these things. And it's usually not quite you would expect. Sometimes you're like, yeah, that's what I would have expected. And sometimes you're like, oh, that's not what I would have expected at all. And I think even though I don't see a lot of evidence-based arguments happening in, the political arena when it comes to people trying to convince you why you need to vote the way you should vote, or they think you should vote, I think it's behoovent upon those of us who actually want to, especially when it comes to things like my money, I want evidence-based approaches to that. I want it based on the facts. And as best we know them.
And separate it from your emotion.
Yeah.
Right? We've talked about that a ton.
Yeah. everything's
and that's why my company in general, we take more of that evidence-based approach, because the numbers don't lie.
Right.
The numbers don't have emotion.
right.
Right. So if we can separate ourselves from that fear, that dystopia that's being sold to us, go out and look out your door and look at your neighbor to the left and to the right, and maybe have a conversation and see that, well, life isn't as bad as the TV makes it. Right. We're all still just working. We still care about our family. We provide.
I've been trying to figure out where to put it in, but I've been tempted to post basically find a way to schedule the most radical sermon sometimes I think I could preach, which is to basically say I actually think the world's probably pretty okay. I think maybe it's not as bad as we think it is. I mean, not down, because there's always things we got to work on, and challenges that need to be met, and I'm not ever saying that. But as a general whole, I would rather be alive now than any time in history before now, and it definitely can be more okay. And there's definitely people for whom it is not as okay as it is for me, being, blessed to be where I am and who I am. But I would still I would defy somebody who really, really says, no, I like now. Now's not really that bad.
I have another one for you.
Okay.
This is from Capital Group. The title of this one is How Elections Move Markets in 5 Charts. Being a charting person.
Oh, man, I
really
love
like
a chart.
this stuff, right? So instead of going back to 1953, now we're going to go back to 1933, because you're like, well, let's look at a little bit bigger window here to see if there's, maybe that stuff we just.
So we're in the Great Depression.
Yep, we're
starting there. That's one heck of a starting line.
Right.
Great Depression.
Yep.
Pre-World War II.
I want to read this first paragraph here to you.
Okay.
And this is from them. So the title of this first paragraph is Markets Have Trended Higher Regardless of Which Party Wins the Election. So politics can bring out strong emotions and biases, but investors would be wise to tune out the noise and focus on the long term. Mm-hmm. That's because elections have, historically speaking, made almost no difference when it comes to long-term investment returns. Which party is in power hasn't made a meaningful difference to stocks either. Since 1933, there have been 8 Democratic and 7 Republican presidents, and the general direction of the market has always been up. What should matter more to investors than election results is staying invested. Now, we took $1,000 in our last example in 1953 and invested it in the S&P 500.
Right.
And it was worth what, 1.69?
Yeah, 1.69.
Okay.
That's right.
So now we're looking at a 20-year difference in time period. We take that same $1,000 and invest it in 1933.
1930. Not a bad time to be buying.
Not a bad time to be buying. And we keep it invested until the end of 2023. What do you think that's worth if the last one was 6.19 or 1.69, excuse me?
I'm going to go 3.5.
24.8.
God. Wow. And I mean, even yes, $1,000 today isn't worth. $1,000 in 1903 was a heck of a lot more money. You could buy a car for $1,000, and it's still not what 20. What did you say it was?
24.8 million.
Jeez.
Now here's the interesting thing to think of. Okay, let's say that I'm an advisor in 1933, and I tried to say, hey, listen to me. We invest this $1,000. It's going to do really good for you in the long term.
Right.
The fear and emotion that they're having is at that time, there was the Great Depression.
Yeah.
Right? And then there was, after the Great Depression, something else. And then there was something else. And then
World War II, and then there was...
It's never a good time to invest if you look at the, if you look at the year in front of you, what's going on, there's always some reason to not invest.
Right.
But when we're thinking long term, it does not matter.
Yeah, and to be fair, it's not like people were, having a 90-year horizon on their investments either. I mean, unless somebody was planning to live a really long time, inherited some money really early, and but I mean, I think wherever, I think anywhere you take a 20, 30-year slice, I'm kind of looking over your shoulder, your chart, and I'm like, I don't see a 20-year or 30-year slice in there where at the end of that 20 years, you're not a lot better off than you were at the beginning of it. Yeah. If you just got in and stayed in.
I always tell people, just based off historical numbers, if I invest money for you in the first 5 years, I could be a hero or a zero. There are periods of time where you invest for a 5-year window and you don't make any money.
Yeah.
The odds are at a 10-year period, much higher that you're going to have a positive rate of return at the 10-year mark.
Right.
And you go past that, and there's not really periods of time, if you look at the S&P 500, that are negative over more than 10 years.
Right.
So again, I'm an odds person. I like evidence. This is the evidence we have to use, and we're just trying to make good use of that information. Doesn't promise anything to the future, though, just to be clear. But
so I'm hearing clearly first right now is don't freak out.
Here's some more fun facts for you.
Ooh, fun facts.
Now,
this has been more fun than I thought.
We talked about, who's in the White House.
Yep.
You were referencing, Congress.
Congress,
the Senate and the House, and what happens. And, you have a split Congress. You have a unified Congress, right? Is everybody the same, or is everybody opposite in all the House and the White House? And
they got all three. It is like one got the Senate, one got the
So the periods of time where we had a unified government, right? So you had the same party in every role, in every house. So it was all Republicans or all Democrats.
Yeah. In majority. So majority was Senate, majority in the House, and then a president.
And you have the president too. So the average annual return over that same 90-year period for when that occurred was 14.4%. Okay, that's average annual return.
That's not bad.
That's pretty good.
Pretty good. And it doesn't matter who it was, though.
Doesn't matter.
Okay.
It was Republican or Democrat.
All Republican, all Democrat.
Yep. Now, what if we have a unified Congress and the president's in the other party?
Okay. So gotcha.
A little bit more gridlock, right?
A little bit.
11.7% rate of return. Would you be unhappy with 11.7?
No, I would not.
No, you would not. Now, what if it's a split Congress? You have a Democrat Senate and a Republican House,
and
right,
then
or vice versa.
Right.
13.7%.
So all those scenarios, it's somewhere between 11 and 14%.
You got it.
I'll take any one of them.
You got it. So what are we supposed to do, Jeremy?
I think we're supposed to not freak out
and just
stay invested.
You got it. Stay invested.
Yeah. But it's boring, Roy. Stay invested is boring.
Super boring, right?
Boring is best.
And that's why, I'm not selling fear.
Right.
People aren't like, man, I really want to listen to Roy talk.
Right.
Super exciting.
Yeah.
Another thing that's kind of interesting too.
Okay.
Is you can track kind of what's going on out there in regards to fund flows. Where is money going? Is it going into the market, or is it going into, let's say, money markets?
So basically, it's going into a market where there's greater reward but greater risk, versus is going into money markets,
right?
Very little risk, less reward.
So a lot of people
more conservative, like financially conservative, versus more risk.
Yeah.
Okay.
So a lot of people talk to me about, well, I've invested. These are not current clients or anything, but I've invested. I've never made money in the market. So I always immediately go to, okay, what decisions are you making along the way? And one of the things so average net fund flows by year of presidential term. So this is in the year of the presidential term. So out of
4 years, so the first year, second year, third year, fourth year.
1992 to 2023.
Okay, it's pretty good span of time.
Presidential election year, equity funds gained $37 billion. Money market funds gain $195 billion.
So way more going into the lower risk investments than going into the higher risk.
You got it.
In election years.
So
like 2024.
Right.
Okay.
So if those people don't make those decisions and they stay invested, if it's invested money, they're going to get a better return.
Right.
But they're trying to hedge a short-term situation, being who's the president.
Right.
And it can actually have a much negative impact. Now, the year after the election.
Right. So first year of
the presidency, they've been elected. The 1 year after, $202 billion goes into the equity funds. $85 billion goes into money market.
Okay, so we're getting back in.
So now they're like, oh, I have confidence now or I shouldn't even say confidence. I should say clarity of policy. What is this new president going to do? What's the policies that are coming out of it?
Right.
And they feel like they have more confidence, right? But
which you can understand totally kind of makes sense, because when you don't know, you're like, oh, I don't know which way it's going to go, so I don't know, I mean, I kind of get it. I mean, I kind of get that it's the lack of clarity. You're like, I can't plan for what I don't know is coming.
Yep.
And
those are making short-term decisions that are hindering your long-term return.
Right.
Right. So, investors should not allow pessimism to steer them from their long-term investment plans.
Right. Okay.
And that's whether you're right now, let's say you're concerned that Kamal is going to win, or you're concerned that Trump's going to win, and you're pessimistic about whichever one of those you are. Don't allow that to dictate your long-term money.
Right.
Short-term money is a different conversation, but we're talking long-term money here. We're not talking short-term, and short-term has a different set of rules, right? On what are we doing with that, or why do we have it, or what expenditure is coming up.
Right.
Much different conversation.
Yeah, because if you think about it, we're not actually investing in the present. We're investing in companies that have business models and do things, and that kind of stuff. It's not like you're not buying stock in the president of the United States, right?
Well, what are companies but people?
People, right?
We make decisions based like people make decisions.
Right.
So if the president that comes in, or the Congress that comes in, or whatever it ends up being, makes decisions that are going to impact some company,
right?
That company is then going to start making decisions based off of that then will still try to drive their long-term return. Right.
It's not like Apple's going to suddenly decide we're going to make cruddy phones because the person we didn't like got elected.
Yeah, they're going
to figure it out, and they're a $1 trillion company. They're going to figure out how to make them for an affordable price, whether there's tariffs in China or not. I think they're doing more manufacturing in India now.
Yeah,
actually.
well, maybe that's one of the things. They're like, well, we're going to move some of our stuff to India now because China's a little bit bigger risk to us.
Yeah.
Right. So Apple made a decision based off of previous, regulation or administration decisions, and now they're going to be able to continue to make money, and they just evaluate the playing field that they're on, and they make decisions based off the rules.
I have one thing I have a high degree of hope in is American corporations figuring out how to make money. Well, they seem to be pretty good at that. That is a consistent thing, no matter who the president is. That is, especially large American corporations, figure out how to make money.
Yep. That is accurate. So anyway, so that's just the big piece of this article. Again, this is Capital Group that put out how elections move markets in 5 charts.
Yeah.
Right. So those are just some evidence-based examples for you of if you come to an advisor and ask them what they should do, right? I don't have a crystal ball. Neither does anybody else, by the way.
No.
And if you have somebody out there saying that this is going to happen, let's say that after the fact they're right, are they going to be right next time? The idea is a broken clock is right twice a day. So they're probably not going to be right again.
Right.
If they did happen to get lucky, which is actually a detriment to them because then everyone's going to expect them to get it right, and it's impossible to do.
Right.
So staying invested, staying diversified based off of your goals, your priorities, your personal plan is what you should do.
Yeah.
And take those ebbs and flows, the ups and downs, because you're going to have better returns long term because of it.
Right.
Right. And separate that emotion.
Yeah. Well, and I think there are important things that people base their political opinions on, and definitely, things like social policy and stuff like that, are a big thing. So I don't want to I would hope nobody's construing what we're saying that politics and elections don't matter, because I very much believe that they do. I think we overblow what they matter here, and it's really convenient for politicians, especially, to go after fear around our pocketbooks, because it's something we all have. Nobody feels like they have enough, right? So I think it's a convenient place to go. But I think if we're also honest about it, they don't actually have. What you're sharing me is they don't actually have as much influence there as maybe they do other places.
Well, it's all short term.
Yeah.
Right. And we're just trying to stay long term.
Yeah.
So the short term consequences of an election are real.
Yeah, absolutely.
And the decisions that we make as investors needs to be with a long term lens.
Right.
So that president that's on TV today or tomorrow, that really does not impact your long term goals.
Right.
It impacts your short term. It impacts maybe your pocketbook, the tax rate, all these decisions that can occur from a presidency. Right.
Absolutely.
So being that we're in the free market system we're in, right? If God forbid our elections, took us into a darker place where we had communism or something like that, then a free market doesn't exist, and then anything I'm talking about doesn't even matter.
Right.
So,
but
hope that doesn't happen. But it's happened in other places of the world.
It has. You can't deny that it has, and nobody's big as us.
That's the biggest impact, though, that could occur to you through an election.
Right.
That would ruin your long-term returns.
Right.
Right.
Something fundamentally changed about the way the economy works.
Yep.
But I mean, I don't know. I guess I don't have a lot of hope of anybody, even if they wanted to, getting something like that done.
Yeah, well, who knows? Another big thing I have too is a concern around the dollar. It's election year, and some of the things that will affect the short term and potentially long term is our currency.
Right.
And I get a lot of questions around that. And I always tell people, if you have your dollar sitting in a shoebox, even today, it's getting eaten away by inflation. Right. So let's say that I think the rate's somewhere between 3 to 4 right now for the long-term inflation rate. A few years ago it was much higher.
Yeah.
So we've gotten that to come down quite a bit. But if you are sitting in cash and it's just sitting in a shoebox, you're actually getting behind because your cash is worth a little bit less every day, right? Well, what if worst case happened and the dollar collapsed, right? Because of the politics, whatever, right? That would be what causes it in the long run.
Right.
I always tell people, would you rather have money in cash, or would you rather have ownership of a company that has a chance to continue to create a product that now whatever new currency evolves has some sort of value behind it?
Right.
I think that's a pretty logical way to look at it.
Right.
And that's why we don't put all of our money in cash. Right. Unless you have so much cash that you're never going to run out. Right. I don't know many people like that.
I don't know.
Maybe the Jeff Bezos of the world or something.
Yeah. Oh yeah, he's got plenty. He just sleeps on giant piles of it, I'm sure.
But most of us can't let our cash sit idly by and not earn us anything. And we have to put it in something. So buy quality, stay diversified, make sure your short-term money is your short-term money, which cash for that is appropriate.
Sure.
Right. But other than that,
I mean, especially in a time when you're still getting 4 or 5% on a money market or something.
Money markets are great.
Not a bad time to do
Money markets are great right now. They will potentially come down as rates move.
Yeah, yep. Mm-hmm.
But who knows what's going to happen? Will rates come down? Will rates go up? People, especially economists, like to pontificate about what they think is going to happen. But the reality is the economy will drive that decision. And if we get a slowdown in the economy, we'll lower rates. If we get a speed up in the economy, we might raise rates. Yeah. That's just kind of the fundamentals behind it.
Yeah. So there are places beyond just stock market returns where this does impact. So I think inflation is one of those, especially if you have international travel and the value of the dollar. I mean, I happened to, like last spring when I went to London, I caught it at a good time as far as the exchange rate goes. And, that can shift, so it's not without its consequence. But I mean, for kind of stuff that we like to talk about here in this podcast, where we're talking about your long-term financial health, the truth is, the best thing you can do for your long-term financial health is stay consistent.
Yeah.
And, have a plan and stick to the plan. It's when you start deviating from the plan that, you introduce the challenge, you're self-introducing risk.
Yep.
You're introducing risk that was not previously there.
Yep.
And anytime you introduce risk, then, there's a decent chance, you're increasing the chance you're going to get bit by something.
Yes. And, there's so many factors, like you were kind of saying, the market is so big, but the economy is even bigger.
Yeah.
Right. The economy is even bigger. So a president, a party, politics, they can only impact the economy so much. I think of it like our economy is like the concept of the Titanic, right? We need to turn the Titanic, but you can't do it on a dime.
Right.
It takes time to turn that.
Right.
So policy can affect that, but it takes time to implement. Which is kind of that lag effect I was referencing before. The Federal Reserve can influence it, right? The economics of, per sector, right? So let's say that it's Apple being in the tech sector. The tech sector has been quite booming,
right,
for the last 3 or 4 years. They have the Magnificent Seven, as they call them,
right? Yeah, well, you got with NVIDIA and the AI chips, and all that kind of stuff. That kind of came out of, not really came out of nowhere, but also like, well, this is suddenly a thing.
It's driven by innovation.
Yeah.
So innovation can affect, right? And with the free market system, as long as we continue to have that ability to innovate, there's so much efficiency that can be created. AI is the next big one, right?
Yep.
We're in the middle of it now, and a lot of companies are spending a lot of money on artificial intelligence. We haven't really seen a specific payoff yet,
right?
But it's probably coming,
right?
Right, and it's a tool that can be molded into something else that can then make efficiencies,
right?
Right. So then, let's say that a company, even like me, a smaller company, if I can have AI help with some of the task work, well, maybe I'm actually more efficient, hire one less person, and then the company has potentially more profit.
Right.
Same thing happens for all these publicly traded companies when they're trying to create efficiencies. So innovation is a big part of that as well. And obviously our decision-making is the biggest.
Yeah.
Whatever we do, the decisions we make, do I over risk something or under risk something? I was talking this morning with one of my colleagues in my Rotary Club, actually, and they know someone that actually has a $10,000 a month mortgage.
Oh my gosh.
And they're 50. The people they were talking about were 55 years old, and she was just like, I don't know how they're ever going to retire. Right. But those people kind of took a big risk.
Right.
And those decisions, not just the stock market decision, but those kinds of decisions, if we over leverage ourselves and we have more debt and we don't track our spending, we don't actually have a plan. Mm-hmm. Those are the things that can really derail us the most and hurt us the most.
Yeah. I think that thing about innovation and disruption is important because I think that's the thing we're afraid of. Like when the president comes, it's like something's going to get disrupted, right? Like something that we counted on before, or, something's going to get disrupted, whether it be an industry or what, because of a policy change or whatever. And it's not that disruptions don't happen, but if you think about the disruptions that matter, they're usually technological, innovation-based disruptions. Like anytime I see arguments about, well, if you want to, look at the economy in the late 90s, it was boom, blah, blah. And I'm like, because of the internet. I mean, it was just like, we invented this little thing called the internet in the late 90s, and Google, I was there. I was in computer science. I was a computer science major at the time, and I'm like, it changed stuff, but it didn't really, the internet was getting invented. It didn't matter who the president was, right? I mean, that's just the way it is. And I think it's the same today with AI, and it's been the same way. I mean, it was Industrial Revolution. I mean, you go back and back and back and back. So I think there are big things that can affect the economy, and disrupt the economy and how it works, and things have to adjust to. But again, I go back to like, I'd still rather live in a world with the internet.
Yeah, it's awesome how that's evolved and made a change for us. But the other piece that people forget is a down market is dreaded, right?
Yeah.
Oh, the market's going down, the world's falling apart. But I always want to remind people that a down market is actually an efficiency tool. Right. So if you're a company and you're experiencing a decline in revenue, right, what are you going to start doing? You're going to start figuring out ways to create efficiency, to trim the fat, right, to boost those profit margins. Mm-hmm. And profit is what drives the market. Right. So as companies have a pullback because of bad economy, let's say, they evaluate, they evolve, they innovate, create efficiency, drive profit up. Profit up drives market up because there's value there to be had. And that is one of the most important things that the market actually has to create efficiency is a declining market, a bear market, which is good. It's good in the long run because that's good for us long-term investors because we're always going to have efficiency. But you get flat, fat, and bloated economy, companies, down market, some triggering event happens. Everything pulls back. We all look at ourselves like, oh, geez, we need to reevaluate our waistline here and lose some weight and become more efficient. And then when you do, then your profit margins can go back up and you start to cycle again, right? Yeah. Right. It's an expansion, retraction kind of cycle that occurs, and that's natural and good.
Yeah. And you see it in nature, you see it in everything, you see it in humans. I mean, we're not really all that great about living in a life of complete abundance all the time. Like that is not a healthy situation for people.
We need strain.
Yeah. Well, and so what do? We artificially create it by going to the gym, right? We don't get out enough. We're not working in the fields anymore and all that kind of stuff. So we have to actually go artificially create strenuous situations for ourselves, and pay money for the privilege of doing it, because we can't just sit on the couch all day, even though that's, and I think you saw the same argument when they had to move away from like zero interest rates and the feds and everything. They're like, we can't live here forever. Right. I mean, you just can't do that. It just, there's
it's a market cycle.
You need something, and it's not fun. And I don't necessarily enjoy my time at the gym. I mean, sometimes I do, but I mean, it's something you got to do. I mean, if you want to be healthy. So,
and I mean, how is a diamond created?
Yeah.
I mean, it's the pressure, right? Iron sharpens iron. Right. Those things are needed as human beings. If we're just fat and happy, we become Rome.
Yeah. Let me see. How'd that work out for them?
Yeah, exactly. So anyways, that's the evidence-based approach.
Okay.
A few good articles that people can reference. Hopefully you learned a little bit about, stay the course. Don't panic. Separate your emotion from your investment decisions. If you're not working with someone that's a financial planner or a financial advisor, consider it. If you're pulling money in and out of the market, it's not a good way to go, historically speaking. But everyone's different. Evaluate your situation and make sure it's right for you.
Yeah. And if you don't have a plan, get a plan.
Yes.
And have some goals and know what your goals. And honestly, again, the nice thing about working with somebody who is a professional like yourself, Roy, is you can also realize what your goals, if your goals are realistic, right? I mean, it'd be great to get 14% return, but you're not going to get 14% return all the time. So you can, but there is a reasonable, you can build a realistic plan, based on what we know, because we do have 70, 80 years of modern market history to look to and say, a lot of these things we've seen before. Yep. And we will get through them. People are still people, so we figure it out.
So not nearly as bad as you thought.
No, not as interesting as the Roth conversion, podcast. No, this is pretty good. But no, I think this is good, and I think it's an important topic, and hopefully we can maybe calm some people down about this particular part about it. I mean, if you want to get if you want to be politically engaged, I think that's great and wonderful. I mean, I think we do need to be engaged in our system, but we also be realistic about what we need people to do and what they can do. I mean, if somebody tells me they got a magic bullet to fix I-25, I'm sold. I don't care what party they belong to. Give me the magic plan to fix I-25. I'm good to go. You're my guy. Or gal, whatever, I don't care.
Yep, doesn't matter.
Yeah, that's where my concern level rises. So good. Well, thank you. As always, you can find us at the About Podcast, everywhere you find your podcasts. We've got a lot of episodes now, and a lot of new ones coming up on some fun and interesting topics. Some good guests coming up as well that I'm looking forward to share with the folks. And we're going to try to keep doing these timely ones, so we obviously got the big election coming up and all of everything that goes along with that. But hopefully we can help people relax at least a little bit about some of that.
Yeah, at least a little bit.
Yeah.
Fear sells, remember that. And the media is not a fiduciary to you.
No.
So that's really important to remember. They're not our friend.
No. Unfortunately. All right. Well, thank you, Roy. I appreciate your time and energy, as always.
Thanks, everybody.
Yeah, thank you all.
CWA is a Securities and Exchange Registered Investment Advisor. No content contained herein should be construed as an offer for investment advice or an offer for the purchase or sale of any security, insurance, or other investment product. Investments involve the risk of low loss, including loss of principal. Please consult with a qualified financial, tax, or legal professional before implementing any strategy presented here. Data presented here are obtained from believed reliable sources but cannot be guaranteed as to completeness or accuracy.